Manhattan is doing really well, which is kind of, against conventional wisdom because we went into this year, tariffs are coming about, rates haven't come down. So what's sparking the activity? The tariffs could actually be a good thing for our client base because a lot of the super affluent want to now diversify their portfolio, like right? Like given what you do, a lot of people are pulling money out of equities, or they did prior to this, all the tariffs being implemented, and they're parking money in real estate. We're also seeing real pent up demand going on here. There's, Manhattan again is the epicenter of wealth. So a lot of conventional wisdom is thrown out the window with, our demographic of buyers in the city. But we are seeing, I mean, we had quarter one, which is not historically a very active quarter. When you compare it to the height of the market, the height of the New York City real estate market
Right.
of all time was 2021. Quarter one of this year was only about 7% below 2021's first quarter in terms of transaction activity. And it was a significant uptick from the last couple of years. So like things are, going really well in the city. And I can't say exactly why, because again, like, if you
Yeah,
would have
because
told
people actually
me,
aren't selling out of the market. Believe it or not, if you look at statistically, retail investors actually added money to the market during tariff turmoil, which I'm not sure if it's over yet.
right.
So that is kind of surprising given the fact that money hasn't actually come out of the stock market.
And then it's also too, the majority of our volume is on the high end luxury market. So, you're talking significant dollars that are going into New York City real estate, So it's interesting you say that because I do think there is some level of diversification, but it's interesting you're saying, statistically, more money's entered the market since all this.
How much of that in New York City is bought in cash? Like, are mortgage rates not as much of an issue here because people
Take a wild guess. Take a wild guess.
upwards of 50%, I would guess. Yeah.
Normally, normal times, it's around 50% cash. The last 2 years has been above 70.
Wow.
Yeah, above 70% in cash. And you're talking like a studio goes for $1 million here, right? Like you're not talking like Bubkus. Like your average transaction is what, $2.5 million? The level of cash is astounding.
Is a lot of that U.S. investors or foreign investors? Like, what is the ratio?
All U.S. investors these days.
Fascinating.
Foreign investors have not been a big part of our market for at least a decade. You'll see like blips, like, we closed a transaction for a foreign investor for $50 million a month ago. But historically, we would close several transactions for foreign investors a month in price ranges anywhere from, $2 to $50 million. Now it's kind of like, far and few between, quite honestly. It's mainly because foreign investors, when they first flooded our market, you have to keep in mind, right? For them, majority of the reason is exchange rate plays, or if there's economic instability in their home country and they view us to be more stable.
So when Chris tries to get his money out of Russia, are we still seeing a lot of because I remember a couple of years ago, Russian buyers were a big part of the market, Chinese buyers. So you've seen a lot of that dry up.
A massive slowdown in that. And then, China, also keep in mind, for years, they had a $50,000 cap on how much money you can take out of the country per year, right? And they didn't enforce it for God knows how long. And then when, maybe a decade ago, I think it's been about a decade ago, they started really like strictly enforcing it. And that killed, the volume of Chinese buyers coming to America.
What's the craziest deal that you've seen recently?
That's a loaded question. I got to think about that one. You may have to give me a minute to brainstorm through all of them. They're all complicated these days. There's a lack of urgency, right, in the market as a buyer, but at the same token, there's a low level of inventory. So it's a challenging market. It's been a long 3 years in real estate. Like we have not had, it was great 2021. Things were flying off the shelves. People were buying left and right. There was no time to second guess anything. Now you're starting to see glimpses of that come back, which is good. But crazy, I don't know, I got to put some thought into it.
Well, I guess as part of it, are people actually starting to cut their prices that are selling? Because it seems like, you're right, you've had this standstill going on where rates have gone up, but people selling their homes still want the same price. But you kind of have to adjust the price downwards to compensate for the fact that interest rates are higher. Is that
Sure.
more the catalyst?
It's definitely happening, but nowhere near in conjunction with like the gross increase in interest rates. It's not like it's coming down at the same percentage. So it's definitely, I think for New York City in general, it's certainly come down. Pricing has come down, which is creating a lot of the activity. Negotiability is at a healthy level. When you look through the country, I think that we just had the first reduction in home values in years last month, but it was 12 basis points. Right? Who cares about about 12 basis points. You're talking about a 50% appreciation in the last 4 years. It's nothing, right? It's nominal. So I do think that, for the rest of the country, that's why volume's so low, because it isn't nowhere near adjusting in conjunction with rates. In New York, it's adjusted a little more.
So, going back to the demographics of people that are buying, are these people that are in New York full time? Or are these people that have, places in San Francisco or places over in Europe? I mean, what's the demographic?
It's a great point, because I keep saying time and time again, my biggest fear for New York City is that it's becoming a pied-à-terre city. We have had the largest influx of second home buyers come in the last 5 years. And, the pandemic, look, the media grossly blew out of proportion the amount of people that fled New York and the exodus. And, half of New York's gone. New York's not gone. I mean, rents are at all-time highs.
Brian always said New York wasn't dead.
Yeah, it's nowhere near. If anything, it's as vibrant as ever. It may be dirtier than ever, but it's as vibrant as ever. But the problem is, though, it is a lot of second home buyers, because people that do live here full time, they're fed up of the crime, they're fed up of the filth, and cost of living is also at an all time high as well. So when you take those factors into consideration, people who live here are like, what, maybe I don't need to live here. But other people are like, hey, I want to come for the weekend, I want to come for a month, I want to go to Broadway, I want to go to fine dining, I'm going to take my driver to take me. They don't see what we see on a daily basis. They're not riding the subway. They don't, if anything, all they see is, hey, I'm buying a $10 million place for $8 million, and that I just got a great deal, right? And the beauty of the city's still there.
So maybe no one's smoking crack on their stoop like mine in the morning, which does make for a nicer experience.
You're right.
But I think, you're talking about that influx, you're right, because there was this big thing in the media about how everyone's leaving New York. I think a lot of wealthy people did leave New York, but you got this whole influx of Gen Z. And I live downtown, so I see it's just become a huge influx of the younger generation coming in, which kind of makes sense why rents would continue to go higher, because if you're coming to the city for the first time, you're not buying a place. Are you seeing that too from a transaction perspective? I mean, it sounds like it's way more affluent people, because if it's 70%, you're putting all cash down. And to your point, it's a lot of people that are using it for their pied-à-terre. Is it more, I guess it is all affluent people that are buying that, essentially.
All affluent people,
Yeah.
right? Because they're not interest rate sensitive markets, or demographic, I should say. Like, think about it. I always joke, I call them semi-normal people who buy $1 to $3 million homes, right? They're going to save, put down 25%, 50%, maybe maximum. And that interest rate is a big factor in what their monthly carrying costs are going to be. It's funny to think that's average in, New York City, where the rest of the world, you're ultra wealthy. The people buying cash at 5 million plus, they don't care what rates are. Doesn't really impact them.
Right. It makes no difference at all.
And then the other big thing that's happening in the New York City market is the commercial real estate. And this was, I think, what a lot of people were concerned about post-COVID is everybody started working remote. They were saying, we don't need as many office spaces any longer, and they were going to be empty, and we were just going to have this huge glut of commercial real estate. What are you seeing on that end of things?
So office is a tale of two cities. There's Class A, and then there's everything else.
Like us.
Yeah. Like
yeah, this is not Class A.
Class A is performing well. I think pricing has probably come down slightly since pre-pandemic levels, but the major corporations that need to have that fancy, glitzy office space did not downsize. If anything, they may have, doubled down because they got a good deal and got a discount. It's your average office market, right? Class B and everything. That's where smaller to mid-sized companies said, okay, I can cut a massive, what's my biggest expenditure after payroll? My rent, my office rent. And those are the companies that we've seen go fully hybrid, adapt the remote model, have whatever hoteling they came up with. I personally, I'm not a fan of this stuff, right? Like, we've adapted the hybrid model in our office just because you have to adjust with the times. Fully remote, I think, is ridiculous. I think it's terrible for the city. You talk about stimulating local economy. Like, you can do your job remote. I can do my job remote, although I don't. I think it's absurd. The person who runs the local deli, runs the local dry cleaner, runs the local shoe shine place, your jobs that require, companies that require physical attendance and presence in the city, they're the ones suffering the most. And it's really sad to see. So it is a problem. It has gotten better, but it's not a problem that's ever going to be fully resolved.
Are vacancies still really high? I think for commercial they are, right? It hasn't.
Oh yeah. The amount of office space on the market and all millions of square foot available for sublet, it's It's crazy.
Is a lot of that can be converted to residential? Does it stay as commercial? Like,
You know, they talk about it all the time, right? Like the problem is, bottom line is, majority of the floor plates don't work for housing, and the economics of it are how big a discount are you really buying these buildings for, where you're going to be able to convert them, bear the cost of construction, and make it profitable. You're seeing it here or there, right? There was one downtown that recently happened. It's not going to be nearly as popular as the media or our politicians like to paint the picture to be.
So what happens with those vacancies then?
You know, the crazy thing is, you would have thought that you'd see a lot more blood in the streets. Banks are working with owners. Banks don't want the assets. You know, we represent a number of institutional lenders throughout the country in commercial real estate. They're all just giving extensions. They don't want to deal with it. They don't want to have all these assets on their
kicking
books.
the can down the road, essentially.
They've been kicking the can down the road for half a decade.
Is it mainly old school real estate families that own these buildings still, or is it a lot more institutional? Like, what's the mix of? Because back in the day, it was just like families that had owned these for generations. I think this building that we're in now is owned by some family who's someone's grandfather or great grandfather bought this building a long time ago.
Yeah, I mean, Class B and below there's a large, percentage that's, family owned and operated.
Right.
Once you get into the higher end of Class B and Class A in particular, it's massive institutional money behind
Like
it.
the Blackstones of the world.
Right, that own
Yeah.
everything. Yeah.
Yeah. And what's the hottest area of the city right now? If you were to say, like, where's the next big place that everybody's buying that they have to be?
I mean, people love to be downtown, right? Like, people love downtown. I think that your best bargain right now is Upper East Side. Upper East Side's a classic area. It's
No one
not.
wants to
It's
live there.
no, you're right. It's not as sexy as living downtown. But if you look, it depends. It depends your lifestyle. You'll see more families on the Upper East Side. You'll see cooler people downtown. It's always been the case. It's not changing.
You know, Ra, I think you lived in the Upper East Side your first time in New York, lived in a hallway. I think you should bring that back. Sounds
For
like there's discounts to
$500
be
a
had.
month.
Yeah. So I want to get back to something you said earlier. You had, and I'm a little bit of a layman when it comes to real estate. You had talked about Class A versus, I guess it was Class B. What's the difference? What does that mean?
So, like Class A, you go to Hudson Yards, right? Massive skyscraper, all glass, floor to ceiling glass windows, occupied by Goldman Sachs, whatever major law firm, every huge Fortune 500 company is a tenant. That's Class A. The amenities are ridiculous. It's the views are stunning. I mean, it really is something to see. And then you go to Class B, like my building and your building, right? An older Art Deco building that is a basic office that is nice in a good area, but doesn't have all the bells and whistles that all the fancy brand new buildings have. That's really the main difference between the two.
Isn't that what's happening too? I mean, I read that like the West Village, Greenwich Village area is like one of the hottest places in the city, but everybody wants new. They want the newest building, newest amenities. It's not the older like townhouses per se that are actually the hottest place to be now. That's
For
what
apartments,
I've read.
you're talking about for apartments.
For living, yeah.
There's not much new on the market. Like 80 Clarks is a new project that's come about. The demand is astronomical for it. It's like the new fancy building in New York City, but it doesn't have much competition. The amount of development in the city has declined substantially for especially condominiums. And a big part of the reason is that a play for developers would be to buy rent stabilized buildings, and they would be able to figure out ways legally to get the stabilized tenants out of the building, and then they would convert the building to condominiums. That changed entirely in 2019 when the city drastically changed the rent regulations. So it makes the conversion component, not impossible, but extraordinarily difficult. That's had a big reduction. That's been a big factor for the reduction in luxury condominium new development.
What did they change in 2019?
So back in the day, you used to be able to conduct certain improvements to properties to increase the stabilized rent. And once you hit a certain threshold and it hit the free market rent or the legal rent to convert it to free market, it'd be easier to get these tenants out. And buyouts of tenants were far simpler. That's completely changed. Now, increasing rent is extraordinarily difficult. You have to spend the amount of money you'd have to spend to increase it makes no sense because it's amortized over a far longer period of time in terms of what permitted sum you can use to increase it. And it basically just made it, far more tenant friendly, to put it bottom line.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. Would you say for the most part, the real estate market here is pretty corrupt? Like, do you think?
I'm a real estate professional, so I definitely can't say that.
No, I mean, but it's like compared to other parts of the country, there's a lot more BS you have to deal with in terms of like corruption, people telling you one thing, doing another, that type of thing. Like, what is the overall view of the?
So look, I'm going to tell you this: it's the most cutthroat market in the world, right?
Why?
It's the people, right? You have there's slumlords, right? I'm not going to sit here and paint a rosy picture that it's the most, squeaky clean industry. There's a tremendous amount of slumlords that exist in the city that have made billions upon billions of dollars. And also too, the people,
how they made their money. They're just like, they buy these buildings and they literally put nothing into them and just squeeze out as much rent as possible. Is that how it works?
Yeah, it's a lot of it, or you have a lot of unscrupulous landlords that, back in the day, that's why a lot of the reason these rent regs were changed to prevent for a lot of this stuff. I mean, you would get people, they would get tenants out of these buildings by turning off the heat, turning off the AC, turning off water, they would tamper with their quality of life in an effort to push them out and convert these buildings. Now, did I see it all the time? No, but like you've all heard these horror stories. They are true. They're not all false.
What was the most egregious thing that you ever saw in the real estate market?
Oh my God. I did hear a story of a landlord showing with a baseball bat once. But not one of my clients. I heard it, a friend of a friend in the industry. Let's put it that way.
Okay.
There's been forceful tactics to try to get tenants out over the years. Hmm. Yeah, no, you're spot on. Brooklyn's doing fantastic. Brooklyn's market has skyrocketed, and it's not slowing down. I mean, it's awesome to see what's going on out there. I do think a lot of people who've gone to Brooklyn, it's not, I don't even know if it's cheaper at this point. Like, I mean, it's not, right? Like, it's just a new, cool area, and the development that keeps going into it keeps providing, great, a great new life to live out there. It's really cool. I think that's awesome. Other boroughs, though, I haven't seen nearly as much like action. Like our practice also too focuses on Manhattan and Brooklyn. But like, I know there's development going on in Staten Island and Queens, but nothing in comparison.
If you could fix one thing about the real estate market in New York, what would it be and why?
I would fix Albany. I think that you have a problem, right? Like you have a problem incentivizing developers to develop. You have a affordable housing problem as well. And anything when it comes to, bureaucracy, especially in this city and state, is a disaster. If you want to create, like keep talking about these rent regs, right? That was meant to help preserve the level of affordable housing that does exist through rent regulation. But you need to create more. You can only create more through development. But they're not giving developers a proper incentive to develop buildings with ties to affordable housing.
Like an example, like what's something that could be?
So I'll give you a really funny example. We were talking earlier, like I avoid the political talk like the plague. The one thing I stick my neck out on the line is I never met a human being that liked Bill de Blasio. The one good thing this guy did in 8 years as mayor of New York City, he tied certain abatements for property taxes and permits for developments where if you were to build in certain areas, they'd be zoned between a 20 to 30% requirement of affordable housing in those buildings. So like there's a great project on 57th Street and 2nd Avenue where it was a public school They tore down the public school, built a brand new school, which is phenomenal for the city, right?
Yeah.
And the local residents, and then built a 50-story luxury condominium on top of it, which I believe 20 to 25% of that building is designated for affordable housing units. That's awesome, right?
Right.
That's a win-win. The kids get a much better facility for school. It created, condominium units where it's generating revenue for the city, and it created affordable housing. You only create affordable housing by incentivizing development. That's what I would want to see, and that's your problem. And it sounds simpler than it is, but by the time our politicians figure it out, we'll all be retired in Florida.
Right. Yeah. Well, how undersupplied is the market in general? Like, because my understanding is there's always more people versus the amount of supply that's available, and that's why the market prices always stay so high. Is that correct?
Yeah, 100% correct. I mean, the amount of people, I want to say 70% of people that live in Manhattan rent, and now rents are at an all-time high. So it's
70%. That's
yeah.
a huge number.
Oh yeah, yeah. If not higher, if not higher. I mean, it's the property values are substantial. But yeah, to your point, that's why you always see. That's why you never see a massive drop in property values in New York City. Even during financial crisis, property values maybe dropped 10%. Maybe slightly more during like the worst period of time for New York City. Maybe throw COVID in that mix. Throughout the rest of the country, when we had subprime lending, prices dropped in a lot of the country 80%. We don't see that here. And it's to your point, right? Like there's so many people that live here in a limited amount of supply. It's really supply and demand.
So what made you get into real estate specifically? Like, did you go to law school to go into real estate law?
Yeah, I did actually. So when I went to law school, in my years there, it was the first time it came out with concentrations in your curriculum, kind of like a major in college. And I chose a concentration in real estate. I always wanted to do business law. And I looked at it between, okay, well, if that's the case, I have, real estate or corporate law to look at. Real estate I found to be a little more interesting. It's less, corporate law is all statutes and, boring stuff that puts you to sleep. I found just real estate to be more dynamic, and I really liked it. And I focused my whole curriculum on it. I held out for a job in real estate when I first got out of law school, would only do that. And luckily it worked out. My stubbornness worked out for me. We ended up creating one of the most active real estate transactional law firms in the country. So it's been fun. It's the best thing I can say. Try to find something you enjoy, put your whole, put all your passion into it.
What was the impetus to start your own law firm or your own practice?
Oh man! So I was 2 weeks before my 30th birthday. So this is 2009 during the year Lehman went under, worst global financial crisis. I was dating my wife. We were together, I think maybe 3-4 months we were dating. And I'm like, you know what? I got to do something. This is ridiculous. I'm going to go out on my own. So I call my parents.
Why do you think you wanted to go on your own? What was the...
I always enjoy the entrepreneurial aspect, right? Like I working in a law firm was nice, but I wanted to build a business, right? Like I wanted to add that entrepreneurial component to my career, actually to make it the focal point of my career. And when you're younger, it's easier, right? Like there's a great saying, like when you're younger, my dad used to say this, you have the balls and not the brain. And I remember calling and I'm like, I'm starting my own firm. It's like, I don't know whether to tell you, you're a genius or you're an idiot, right?
The other part of that too is like, I think lawyers traditionally, the perspective is, or the perception is they're risk averse. So I feel like that's actually not the norm to be entrepreneurial and be a lawyer. Like that's an odd combination in my experience.
1000%. And lawyers, honestly, to add another joke to that, they're socially inept. Like lawyers are weird. like they lack social skills and they lack entrepreneurial skills. And I see it every day. And I saw that, like, I felt my skill set was tailored well to that. I always say you have to be really great at what you do in order to sell and market your skills, right? But you could be really great at what you do, and if you don't know how to go do the other component of it, not many people find out, right? So that's why I did it. I really wanted to build a business, and we were fortunate. Like we built a business that skyrocketed quickly.
Did you see? So this was during the financial crisis. And you saw that as an opportunity, or
absolutely?
Why?
So things. Everything is a cycle. It's going to come back. The best time to start a business is in a downtime when you have time to build your foundation, build your network of people, spend the time on actually creating the business, right? Not being stuck being a technician working on everything. And then when you do it properly, then when the market does swing back, and for us, transactionally speaking, right, transaction volumes are flying in, you have the infrastructure to capitalize on it, and you just go and continue expanding, right? Like it's the best time to start a business in down market.
Well, not dissimilar. We started our business in July of 2008. It was right during the financial meltdown. But to your point, what a great time to get started, because really, like, you were at the bottom when it came to market valuations. But I assume the same thing. Like, transactions probably went to like zero in the New York market during the financial crisis. Like, if you were doing real estate specifically, talk about getting in at the bottom, right?
Yeah, I mean, transaction volume was low, but it's New York's always active. Even in down markets, there's activity, right? Like, and the only thing I always say you can do is capture more market share. That's it, right? Like the last 3 years, we've had a low in activity. What did I do? I just worked harder and tried to get more market share to offset the decline in volume. And if you're really good at what you do, you don't feel the pain of market fluctuations as much if you can do that.
Yeah, we have a lot of that in our industry, where especially when the markets are down, nobody wants to do anything. Nobody wants to make a move, which is the best time you should be getting invested or be buying real estate,
Totally.
And yeah, then once it's hot, now everybody's saying, oh, I missed the boat. I mean, it's completely cyclical in our industry too. Yeah, so
Yeah. I mean, how many clients did you have put more money into the market when tariffs went into place a couple months ago and the market's fluctuating 3% every single day?
Well, the key there is you got to keep people invested.
People.
That's the harder part in those downturns. But yeah.
Interestingly enough, though, this time we were getting more calls from clients saying like, oh, should we buy this as an opportunity? And you actually saw that where retail investors were getting into the markets before institutional investors back in April, which is a rarity. But yeah, that was actually happening.
Which usually isn't a good sign, by the way, because whatever our clients want to do in droves usually is not the right decision. But who knows? Short term, I think everything looks pretty good here. And what's your outlook for the real estate market in general? I mean, do you think with rates higher, and they may stay higher, do you think things will continue to slow? Do you think they'll pick up? I mean, what's your view of the New York real estate market, like longer term?
So we've been hoping for rate cuts for the last, what is it now, year and a half exactly. January 24, we started thinking the Fed's going to start cutting rates. It hasn't been anywhere near what we thought, right?
But that doesn't really affect longer term rates, right? Because the Fed did cut back in September, and long-term rates actually went up.
Well, so the mortgage rates are more tied to the 10-year Treasury.
Yeah.
So when the 10-year Treasury went up with tariffs.
But it also went up when the Fed cut in September. People forget that.
Right. That's right.
So even if the Fed cuts, doesn't necessarily mean long-term rates or 10-year, 30 years actually going to go down.
Right, 100%. Like
Yeah.
it's not a necessarily direct correlation between the two, right? Like
Yeah.
the mortgage rates are predominantly tied to the 10-year Treasury. We had, China dumped a lot of their government bonds a few months ago. That all of a sudden made, government bonds, the yield went up, which brought mortgage rates up, right? Whenever something impacts treasuries, where treasuries go up, mortgage rates go up, regardless what the Fed does.
Yeah.
So I do think, look, regardless what you think about Trump, in the night we get 3.5 more years left of his presidency, most people are bullish that he will, in some manner, get rates down, right? I do think that, he does, and most politicians in Washington realize we have the affordability crisis in the country, and rates is really the only thing. You're not going to get pricing to come down substantially. So I do think when rates do come down, and let's just say tariffs work out, everything goes, he strikes deals with everybody, things are booming again. The minute rates come down, I think that it's lighter fluid on the real estate market. I think the level of pent up demand in the last 3 years is huge, and things.
Does
are
that help
starting.
affordability at all?
No.
'Cause then doesn't this bring all the buyers in, and then
No.
prices just go right back
Doesn't
up,
help.
right?
It may help affordability in the sense that you can afford your monthly sum, but it's not going to help your ability to enter the. Yeah, exactly. Like, you're right. Like, prices will go up. The only way you're going to help really create more affordability is adding supply. That's the most important thing, and we're not doing that. How can you add supply when you don't know what the cost of your materials are that you're importing, and banks are giving you loans at 7%?
Well, that's the biggest problem right now, is we have a housing shortage in the country. We're not building fast enough. And meanwhile, unaffordability is just getting higher. Because the other problem is, play devil's advocate, what if rates don't come down? That says to me that at some point you have to have some price cuts on properties, correct?
You would think, but we haven't seen it yet, right? Like, yeah, like that's the thing. Like,
How about nationwide?
Well, so
though?
nationwide, I'll give you a great stat. Over 70% of the mortgages in the country are sub 4%. right? Like think about it. And the majority of those are 30-year fixed. So if you're not
Nobody's moving.
exactly,
Yeah.
that's what I'm saying. Like
Yeah.
who's moving unless you have life events, right? Divorce, death, and family creation. The discretionary moving is out of the equation because of that. If you like, unless you have to move, you're not going to let go of that 3.5% to go trade in for 6.89%. And prices have only gone up since you locked in that 3.5% 5 years ago. You're not doing it. That's why you're in this boat.
But rates probably will never go down to that level again.
I think that if you get to a world where you're in the 4 to 5% range, I think that's where all you need to do. And I think that people would be elated in that environment.
Let's play devil's advocate. The average over time is closer to 7%. So why do we go back to 4 to 5% if we're getting back to historically normal interest rates on
Because
mortgages?
prices weren't what they are today. Prices were 50% lower when we were in a 7% interest rate environment.
Yeah, but I mean, interest rates aren't driven by what real estate prices are, right? They're driven by a lot of other exterior factors like inflation, tariffs, for instance, which are inflationary. So I wonder, there's a lot of people anticipating rates go down again, but I could probably make a good case that interest rates don't go down again. Even if the Fed cuts short-term rates, Trump really can't control longer-term rates. We have the saying the bond gods control longer-term rates, not politicians, unless they do some sort of rate controls, which I think would be probably an extreme measure.
But again, though, like you're talking about sparking activity. You're not going to spark the activity with rates staying status quo. You're just not.
But if the politicians can't control the interest rates and they stay higher, what happens?
I think you're living in this environment. This is it.
Right.
Transaction volume, stays low. We're like, look, I always say I may be biased, but I'm a real estate professional. Real estate is the backbone of our GDP. And when you have activity this low, I don't understand. You're far more attuned to this than I am. I don't understand how economically things are going so well when real estate's so stagnant. And you're going to just continue in this level of stagnation until there's some adjustment in rates. I don't think it has to be an astronomical adjustment, but that something has to give, right? You can't have rates tripling and prices going up 50% and expect that there's going to be movement.
Well, it
You
sounds
just
like
can't.
prices are going to come down. It would be my best guess.
But they're not, though, right? Like we're 3 years since the rates started going up. Yeah, June, it was summer 2022. You're 3 years later, prices have gone up every year in that 3-year time period. It's because you're about 5 million homes short of current demand levels. 5 million. You tell me where you're going to see multiple millions of homes being developed.
But also,
and
right,
what's sparking
transaction
that.
volume's down, right? People are at a standstill. So that is a little bit deceiving in the sense that it's not like the real estate market's moving on all, 8 cylinders, right? So
right.
the question is, at some point, people that are locked in their 4% mortgage but want to move, do something else, at some point, do they actually just say, okay, I'm going to cut my price? And once one person cuts their price, the floodgates open.
If you have to cut your price, right? Like what's forcing you to do it?
If
Again,
you want to
it's
move and no one's buying at your price
But
level.
there's want or have to, right?
Right.
Like if you want to move and you don't necessarily have to, you're staying put, right? Because your alternative is
Right.
it doesn't make sense financially. If you have to, yeah, there could be an opportunity. But I don't even still it doesn't open up floodgates because it's one comp out of how many, right? Like
But don't you just need one?
I think
And then it's
you need
like,
a lot
that's the new
more.
market?
You need a lot more than that.
Well, Pierre said typically for a high-end home in New York, how long is a property that's for sale stay on the market? What's the time?
That's a great question. It really just depends on the market and the pricing. If it's priced right, I've seen them go in a matter of days. And, right now, part of the problem is you have a lot of people who want to hold on to that ultra high pricing that they paid, a few years back. And those are sitting, right? Those can sit for 6 to 12 months. It really just depends on how it's priced.
Something's priced right. Like what number of bidders would you typically see?
Right now, it's not crazy. Like you're seeing, like I'm trying to think about the deals we have on our desk, right? We're probably working on, if I had to guess, close to 500 transactions actively right now. There's not a huge volume of that has multiple people, like where we have a deadline to sign in 48 hours because there's 2 other people who are coming in and outbidding us. There is some of that, but it's not that much, where that's usually like the craziness of a very bull market. In 2021, we had 4 people where you had 48 hours to sign because there's 4 people right there willing to do it that day, right? And we're nowhere near that point right now.
You said it was kind of like that way in 2023 also?
No, 21. 21 was the
That was the peak
yeah,
in the real estate market
the
here.
peak of the market. Like, I mean, we never saw anything like that in our lives.
So how much has the price appreciation been since 21 over a 4-year period?
That's a great question. I don't have an exact stat, but I will tell you, we represent a lot of investors and a lot of second homeowners. And part of it is we have to, if you're a non-New York State resident, I have to go through their potential non-capital gains tax with them. And the amount of people selling at a loss right now is huge. I mean, majority of people are selling at a
So
loss,
it really
I feel
peaked
like.
out in 2021. And since
Yeah.
rates have been higher, you really haven't
That's
seen the
right.
price appreciation.
That's right.
Yeah.
And it's that too, Ryan. And also our closing costs in New York are so high. I mean, your transaction costs are about 10% of the gross price.
Wow.
Your exit, right? Between broker's commission, transfer
Those
taxes.
legal fees, Chris.
I wish the legal fees are at the bottom of the list on that one. But you're talking about like 10%, and then your entrance fees are high, right? Like you have mansion tax that scales anywhere from 1% to 3% of the price on average.
Yeah.
So yeah,
So
so
just
by
the,
time
the full round trip is
15% to a third, 12, no, less, probably 12 to 13% total round trip on costs, right? So you take that, you have to have a significant amount of appreciation to turn around a taxable profit. You do. And majority of people are selling at a loss right now.
That's why Ryan wants to buy it. He doesn't want to pay that mansion tax. But
I know.
What initiates the mansion tax? Is it a price point? Is it square footage?
$1 million.
Whoa.
$1 million bucks.
That's nothing.
Yeah.
Yeah.
you're
give you
lucky to have a
studio.
one bedroom for $1 million in New York.
Exactly.
Yeah, yeah.
That's it was implemented in the 70s, right? And they're not gonna take it
inflation
away.
adjusted, that's like probably $5 million. Yeah.
That's
So
right.
typically happens from governments. Governments say, we're only going to tax the billionaires. All right. Now, the billionaires are not too hard to find. They're too hard to find. So they make it, all right, well, now a million's like the same thing as $1 billion. So everybody pays this tax. That's crazy.
So to go back to this question, what's one of the wildest real estate stories you have for us?
Okay, all right. In general, not as of late. I can give you any my favorite
Yeah,
one.
let's give us your favorite.
So when I gave you the story when I started my own practice, right? So the week I start my own practice, I have an old client of mine call me up. Him and his husband are buying a building in Harlem that was once a synagogue, and they're going to convert it to a 10,000 square foot mansion, and that there's a lawsuit and that there's rioting, and they're not really sure what's going on. It's the first call I get when I'm literally like just had the guts to start my own practice, right? So I love this story. And I'm sitting here, I'm like, all right, well, I don't understand what you guys are saying. They're both famous authors. So like, the business explanation wasn't the best. And I go, let me do me a favor. Like, let me come see the property while you're inspecting on a Saturday morning. It's like the dead of February. It's like 20 degrees. I go up to Mount Morris Park, 35. Oh God, how did I forget the building number? It's on Mount Morris Park West. Show up, put on the hard helmet, walk through the place. It's dilapidated. There's beams falling around. There's pipes open. There's wiring. It's a complete mess, right? The front door's sealed, boarded up. There's riots going on because it was a group called the Black Jews of Harlem that owned this building. So the building was first the Dwight Mansion, which was the owner of Colgate. It used to be a single family residence.
It's a cool building.
Amazing building, amazing. Then it was converted to a synagogue. Now, in order for a religious institution to convey a property, they have to get a court order and attorney general approval. If you get those things, then you can legally sell. And there's two main reasons for this. They don't want developers ripping off, religious institutions and converting these buildings and dealing with, novices in real estate and not getting fair market value for their properties. So you have to show that the developer, whoever the buyer, is getting fair market value. And then secondly, they're not-for-profit entities, so they don't want, illicit activity going on amongst the board where they're taking money and the money's being distributed without being, taxed on if it's not being continued to be used for not-for-profit purposes. So the lawsuit was pending between the disgruntled members of the synagogue and those that authorize the sale, trying to void the sale. In the middle of this lawsuit, my client wants to buy it. So I'm sitting here, I'm like, all right, well, how do I figure this out, right? So I look to who my wife is now. I'm like, if I close this deal, it'll mean that I made the best decision to go on my own and I'll have a very good career. If this deal does not close, I better work on my resume, right? Like,
no pressure.
And yeah, no pressure whatsoever. And this thing went on for months, right? So long story short, we were able to ascertain that the case was being thrown out in a court of appeals, that the transaction from the synagogue to who my client was buying from was a legitimate transaction, and then I could buy from the owner of the property, who at the time was no longer the synagogue, right? It was an investor who was intending originally to convert to condominiums. We buy the building successfully. Client converts it to from a synagogue to a 10,000 square foot residence. And it was just an awesome deal. Like it was so cool. I mean, I can go on and on about all the details of this thing. The Wall Street Journal wrote an article about it. They quote me at the end of the article, and until today, it's still framed in my office, hanging up. And this deal closed, I think, in 2010.
Wow. Okay.
Yeah. So the paper's a little yellow now, but like, but it was really cool. It was just a very like, serendipitous, moment in my career.
I can't imagine having 10,000 square feet in New York City.
I know, right? Pretty cool, right?
Do you think New York's more landlord or tenant friendly?
Far more tenant friendly. Courts in New York City are extraordinarily tenant friendly. It's not even close. I think it goes a lot to just the political nature of New York, right? Like being more left leaning of a city, and trying to help the little guy versus the landlord, massive conglomerate landlords out there.
So the last question we ask every guest: if you can think of one song or album from your youth that changed your entire perspective of the world, what song or album is that?
That's a good one. I'm a huge Billy Joel fan, but I'm an old soul. So, and my kids are 10 and 8. I took them to see Billy Joel last year,
cool.
actually, at the Garden, which is pretty cool. My 8-year-old fell asleep an hour in, and I'm like, that's the most expensive nap I've ever seen in my life, right? But I guess it's my problem for taking an 8-year-old to a 9 p.m. concert on a Friday night. I'd say Billy Joel. It's just been provided great memories and moments for us. I mean, since my little guys were like 5, they were singing all the songs, know all the words. Like, it just really, it's been fun.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, the secondary market for private equity stakes is expanding, where transaction volume hit 160 billion last year, up from 80 billion in 2019, according to Evercore. Sales of investments by endowments often go to investment firms like Ardian, Lexington Partners, and Blackstone, which are creating funds from portfolios of secondaries. Blackstone recently was buying $5 billion in private equity stakes from the New York City pension system. Sounds like retail investors are going to take all this private equity. I don't know if that's a good thing.
Well, I doubt it is, right? Because I've been reading that most of these private equity deals were done when rates were 3. Now they're 7. And suddenly a lot of institutional investors are waking up to the fact that their investment's illiquid. So, wow, voila, all of a sudden a retail investor, also known as dumb money by institutional investors, this is now available for you in your 401k, your IRA, and your personal accounts. Sounds like a deal you should run away from.
Whenever there's something exclusive for the retail investor that was only for institutions before, it's never a good sign. All right, Pierre. In late May 2025, the average rate on a 30-year fixed mortgage rose to its highest point in nearly 4 months, reaching 6.89%, according to Freddie Mac. Elevated mortgage rates have contributed to a slowdown in the housing market, leading to a decline in pending home sales. Are you starting to see, is there a slowing in the housing market, or what's the latest?
So the last 2 years, we had 30-year lows in housing transaction activity in the entire country. Each year broke a 30-year low record. It's a disaster. Transaction volume, Manhattan, forget where we are right now, right? This is a bubble. It's the most affluent region of the country. Activity here is pretty healthy. But throughout the rest of the country, it's disastrous because when you look at the pricing, the affordability crisis that we're in, prices have gone up roughly 50% throughout the entire country as an average since the pandemic. So you have the appreciation of prices at a historical high. And now you have rates that went, that was largely fueled by cheap interest rates back then, 2.5%, 3%. That was great, right? Money was borderline free. Nobody can afford what did you say, 6.85?
6.89.
6.89 with prices up 50%. It's a catastrophe. And it's something that's not being talked about enough.
I know the unaffordability of housing is I think it's the worst since the 1980s or something like that. So that's the last time Chris was cool.
Yeah. Well,
I'm joking.
They like to say back then rates were 16%, but your average home was, maybe $100,000. So it wasn't so bad, right? Now your average home is $450,000 and your rate's almost 7%.
Yeah, it's wild. It's wild. Yeah, and it doesn't look like rates are going down anytime soon, if I'm reading the tea leaves.
Bob, what was the rate on your first mortgage?
I don't remember the first mortgage. I do remember the second mortgage when I bought our home in Pennsylvania. The mortgage rates were 22%. And I thought I got such a deal. I think I got one of the first adjustable rate mortgages back in 1983, 82 at 11%. And boy, I was so excited to get such a sweet deal.
Well, getting a floating rate was smart because the rate just kept coming down from there, right?
Oh yeah, it was a good guess. So, you go long zero coupon treasuries at 14 and a quarter, and then you borrow from the bank at 11. So it worked out pretty well.
All right, Courtney, between weekend home rentals and hotel rooms that go for 5-figure nightly sums, a procession of pricey meals, drinks, and Ubers and outfit changes for every stop, a content-worthy girls' weekend can easily hit $5,000 per person going to Montauk now. That's insane.
This doesn't shock me. I mean, even, years ago when I used to go to Montauk, my friends, it was unaffordable. You had to share a house with friends. And I mean, it was like $20 for a beer that normally costs $5. I mean, it's crazy expensive. But I think what's kind of interesting is, that's kind of a bad example where it's a very expensive place to go across the country. But the travel bug hasn't ended. Even after COVID, everybody thought there was going to be this spike in travel and it'd go back to normal. It has not gone back to normal. People just still want to travel. They're still going to the Hamptons. They are spending money on experiences.
But it's insane. I remember going to a house in the Hamptons for it was me and 20 other people.
Did you take a helicopter?
I took a helicopter. Yeah, I wish. I took a horse. Back then, we took horses to the Hamptons. And I think maybe the whole weekend cost a couple $100. Now you're talking about a couple $1,000. And you go to south of France, probably for a cheaper weekend. I'm not, I know this sounds crazy, but the south of France is much nicer than Montauk. I like that greenish, kind of dark, dirty blue Atlantic Ocean. Much nicer than the Côte d'Azur, for sure. Insane. Hey, hope you enjoyed episode 206, Payne Points of Wealth. You like our podcast? No, you love our podcast. Give us that 5-star rating on iTunes. It's on Spotify. Give us a 5-star rating. You subscribe to our channel. If you're watching this on YouTube right now, you can like this episode, subscribe to our channel. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.